It seems like everywhere you turn these days, you hear about AI. Some are touting it as a revolution, the dawn of a new era, like what we saw in the past with electrification or the advent of the internet.
Basically, we're seeing AI everywhere. And so AI looks like it could be a potential game changer.
That's Rebekah Young, Vice President and Head of Inclusion and Resilience Economics at Scotiabank.
So I think it's holding a lot of promise, but we're just so early stage that we really need to unpack how could this unfold and what sort of impact could it have.
And that's exactly what Rebekah and her Scotiabank colleagues have done in a recent report titled Macro Markets and Machines, the Economic and Market Transformation Driven by AI. It looks at how artificial intelligence is reshaping the global economy, and with it, things like investment strategies.
I think from an investment perspective, what we really want to do is contextualize all of this for the readers in order for them to capitalize on some of the opportunities that are emerging from this, as well as mitigate some of the risks.
That's one of the paper's co-authors, Walid Khalid. He's the Director of Investment Strategy at Scotia Wealth Management. Walid and Rebekah are here to walk us through what they found in their report. We'll cover the impact AI might have on the economy in the long run, how it may affect jobs and productivity, whether there's an AI bubble, how investors should get their head around all of this, and more. I'm Stephen Maurice, and this is Perspectives. Walid, Rebekah, thanks so much for joining us. Appreciate you coming in.
Thanks for having us.
Thank you.
All right. Artificial intelligence, obviously, huge technological development. Everybody's talking about it now, has the potential to change many aspects of our lives and the economy. And you have produced this white paper titled The Economic and Market Transformation Driven by AI. What were you trying to accomplish in putting together this paper? Maybe I'll start with you, Rebekah.
There's a lot of movement on the AI front, from what's going on in financial markets to what's going on in economic activity and business investment, particularly in the US. And so I think we really wanted to unpack some of what we're seeing, some of the drivers, some of the potential impact, because there's quite frankly wide ranges of uncertainty around what it could all mean for the economy in the long run. So we really wanted to just put together what we know, what we don't know, and what we're worried about or hopeful about down the road, and what markers would tell us which path we're on.
Right. For a lot of people, they think about AI in their daily lives, and it's videos that they see, and they're wondering what's real and what's fake and how they can use AI prompts at work. But you're looking at the bigger picture about what this could mean for the economy, both in Canada and elsewhere.
Yes, economists get quite excited when they think about AI because first and foremost, it could be a potential game changer when it comes to productivity. And so we know for decades now in, many countries, not just Canada, that productivity has been declining over the years and over the decades. And so AI looks like it could be one of these things, a game changer. It's cross-cutting. It's not just one particular sector, but could impact economy-wide, labor force-wide, as to how we put together our people and our capital to produce more GDP and produce it more efficiently and more of it. So I think it's holding a lot of promise, but we're just so early stage that we really need to unpack how could this unfold and what sort of impact could it have, not just on GDP and productivity, but on labor force and on inflation, interest rates, all the things that we as economists tend to think about.
Okay, well, we'll jump back into some of those details in a couple of minutes. Walid, I'll come to you. You approach this from the investment side. That's what you do in your work. What were you trying to accomplish in working on this paper?
Yeah, to Rebekah's point, there's still a lot of uncertainty as to how all of this is going to play out. But we're already seeing the impact play out across markets, right? Equity market leadership over the last few years has been quite narrow. We've seen billions and billions of dollars going into this CapEx cycle, and it's because some of the highest quality companies out there believe that this is, in fact, going to unlock productivity gains down the road. Now, whether that happens and to what extent, that remains to be seen, and I'm sure, we'll get into some of that later. But I think from an investment perspective, what we really want to do is contextualize all of this for clients and for the readers from an economic lens and an investment lens in order for them to capitalize on some of the opportunities that are emerging from this, as well as mitigate some of the risks that are also prevalent in the market. And I'm sure we'll get into some of those risks later on as well.
For sure. And how does artificial intelligence compare to past technological breakthroughs, whether it's electrification or the internet? in terms of its potential to reshape productivity and economic growth?
There's a wide range of estimates out there, and we've looked at, Rebekah, myself, and our colleagues, we've looked at a number of different academic studies from reputable sources such as the International Monetary Fund and the Bank for International Settlements. There's really no clear consensus as to what sort of productivity impact we may end up seeing. There are certainly some commonalities, though, between past technological innovations that we've seen over the last 100 years or so, whether we're looking at the Industrial Revolution or electrification, as you mentioned, or the personal computing boom. They tend to boost productivity. They lead to some level of labor market disruption while also creating new jobs. So, in the Industrial Revolution, we went from an agrarian economy into more of an industrialized economy. So less employment in agriculture, more so in manufacturing, for instance. And it remains to be seen. We haven't really seen that labor market disruption play out as much with AI. We may down the road, but so far it's applied to a narrow subset of occupations, such as software developers, particularly junior level software developers, have come under focus. But apart from that, I think the one thing that we can certainly verify that this has in common with past technological innovations is the CapEx cycle. We've seen billions of dollars being earmarked for data centers, semiconductors, software, cloud computing, not to mention energy usage as well. That is consistent with what we have seen, whether it was laying down thousands and thousands of miles of railroads during the Industrial Revolution, or setting up thousands of miles of fiber optic cables across the world, or the number of cell phone towers in the United States has quadrupled since the turn of the century. So this AI build-out is following a very similar trend that we saw with the dot-com era, which is heavy capital expenditures, particularly by the leading firms.
What do you think, Rebekah? Certainly people talk about this as potentially a revolution, that really it could change everything. Not that you necessarily know exactly the answer to that question, but how does this feel to you compared to some of those earlier technological innovations?
When we look back at past revolutions in productivity, I think the one lesson is that they tend to play out over not just years, but even decades. And so we are very early on that phase of the build out. So I would say we have to be patient that we're at the very early stages of this potential revolution. But I would also say we might have to be a bit cautious, if not optimistic. This could be faster than past types of revolutions. And if we just look at the pace of investment, that already we're seeing investments at the scale of the entire build out of the fiber optic scales during the telecom boom. So it's happening very, very rapidly. Now that could be positive for what it means for growth and productivity, but it could also mean that we see faster dislocations, and so that we're not necessarily ready as society, as economies, to make that adjustment that in past revolutions we've had those years and decades to adjust to see labor force moving from some sectors, some jobs into others. So I would say when we look back, there are some things to glean, but also some caution when we look at what we're potentially dealing with today, that very early days, and we don't quite know which direction it's heading. And also we have the policy levers at our disposal. It's a question whether we're ready to use them to put us on the path that looks better through an economic and societal lens.
It certainly feels like it's happening at a breakneck pace, with things like ChatGPT really only coming into part of the public vocabulary in the last 2 or 3 years, something like that. You talked about productivity. Even in that short term, are there areas where it is becoming clear that there are productivity opportunities? I know a lot is still unknown, but are there things that we do know where we see productivity gains happening already?
First, let me unpack the channels that we as economists think about when we think about productivity and output for that matter. And so basically GDP is a calculation of the labor and capital and the productivity with which we use that labor and capital. And so when we think of AI first and foremost is a tool that we can make our labor more productive. We can also deepen the technology or the automation, the robots that we already have, making our capital more efficient. And then there's there's this magic sauce of bringing the two together with tools and producing more. There's a fourth category also in that new world order of AI, what new jobs are out there. And on a rosy path, if there's stronger growth, stronger productivity, there's more demand, more consumption, even more jobs created in an economy as a whole. So if you think of those multiple channels, you then look at, okay, so what are the tools that are going to make people or capital more productive? And that's where we're very, very early days. I would say patience, because we are early days. I think we've got some tools, wrinkles are being ironed out. We're still trying to figure out now, how do they work? Are they safe? What about privacy? What about hallucinations and accuracy? So we're still early days, but what we are seeing is, if I look at Canadian statistics, for example, that we still have only about, a little bit more than 10% of businesses that say they are trying out these different AI tools. It's about a third when we look at some industries like finance or professional services, information technology, but they're still using it for things like data analytics, text analytics, customer service, chatbots. So it's still scratching the surface of just how powerful it can be. And it's still fairly limited so far in the data that we have. And is it making us more productive or not? Or is it distracting us from our job? And there is a learning curve as employees, companies build those systems, invest in the technology and the software to use and test them out, train them for their own purposes. We wouldn't expect to see that in results or productivity just yet. So again, that's not to say that it won't hold a lot of promise, but we're still very early days. And I would also point out that you also see some numbers that can be somewhat fear-mongering out there, that say, okay, 60% of labor force is exposed to AI. And I would caution that because a job or a task is exposed to AI doesn't necessarily mean it's going to be automated away. It could potentially mean that it's going to be an augmentation. AI is going to provide a tool to do more with that job. But I would also say you have to factor in the economics of it. So even if a job is exposed to AI right now, it may not be economical for a company or an economy to automate away that job, just given that cost dynamic, labor versus capital. So we're still very early days in kind of determining which tasks, which jobs, which economies are more exposed versus having a greater opportunity.
Walid, anything to add to that?
Yeah, the labor market, as we know, especially in advanced economies, has been dealing with some structural headwinds from factors like declining birth rates, aging populations, and now many parts of the world, tighter immigration policy, all of which, all else equal, constrain labor supply. So to kind of add to what Rebekah said, it's still early days. We don't know how this is going to play out. This is kind of another wrinkle in there where we don't know how those dynamics between lower labor supply are going to interact with AI. Like, is this potentially an offset to us having less workers down the road? So that's also something to think about.
Yeah. I think it's worth spending time thinking about the impact on labor markets, even though we're talking about AI as a capital-intensive tool and we're early days where a lot of investments going into that capital and software, because ultimately, especially for policymakers, it's keeping an eye on what does happen to labor markets. In the short term, we might see this kind of capital-intensive, capital-favoring, equity market favoring developments, but over the medium to long run, if we see much broader employment hits or wage hits from greater automation versus augmentation, that leads to a whole other string of challenges, whether it's government revenues or whether it is inequality in societies. And it's even that aggregate demand. So remember, these companies are making these investments in hoping to sell products and services to consumers. And if they leave behind big factions of those consumers, they're not going to have that same degree of demand, even if they can produce widgets or services more efficiently.
Yeah, I mean, it's a very complicated question. I think a lot of people, when they look at AI, they wonder whether AI is going to be coming for their job at some point. And there's that concern that a lot of people have. Are we seeing it anywhere already in real life? I mean, you talked about software developers.
Yeah, I would say it's a very narrow subset. There's one report that comes out every month, the Challenger Jobs Report, which is focused on the US and essentially provides information on job cuts and why those jobs are being eliminated. And yeah, like AI is being cited sparingly every now and then as one of the reasons for headcount reduction. but it's not even close to being at the top of the reasons. Top of the reasons have to be with cost-cutting measures, a lack of demand for a company's products. That's really what's been driving some of the workforce reductions in the United States. It hasn't really been AI. We did talk about software developers. That's mainly junior level software developers, and particularly those in the under 30 cohort, which are seeing employment trends decline. Whereas software development for more experienced professionals, employment in that field is actually continuing to rise. So at this point, I think we're seeing a very narrow subset. And the headlines, of course, that we do see, I think those headlines are quite loud, but they may not reflect the reality of what's happening today. That's not to say that we might not get further labor market disruption, but in the here and now, it's quite limited, I think.
It's a really good point, and it doesn't take an economist today to come up with a list of what might be holding back employment. So we know whether we look at Canada, US, labor markets are slowing and there's policy uncertainty, particularly in the US, still high interest rates. Tariffs have been an issue, just this pervasive sense of uncertainty that's leaving a lot of businesses on hold. So you layer in AI and this rapid pace of potential change is just one more reason why businesses may be hesitant right now to hire or maybe even reducing its workforce. So again, very early days that we need to monitor what happens. And maybe at the micro level, we'll see more and more companies laying off or reducing their labor force. But on the aggregate, it's difficult to tease out the cyclical from the structural forces at this very early stage.
So there's the potential for disruption. We don't know exactly what form it's going to take or how intensive it's going to be. But how can policymakers and businesses prepare for some kind of uneven transition as AI gets adopted and implemented?
I'm going to focus on one really big issue that'll be at the forefront of policymakers' minds right now, which is governments really rely on labor income as a major source of revenue. So that's upward of 60% once you look at personal income tax, payroll tax, security contributions. It's a really big source of revenue. And so if you look at a path where the disruption is faster, we see higher unemployment rates that not only will they be losing revenues, they will also have higher expenditure because of these unemployment programs. So policies really need to be geared towards shortening that disruptive period. How can you really reskill, retrain, rematch labor force and get them into either existing or new jobs that may be created along the way? Because quite frankly, we can't afford, as economies around the world, to enact things like universal basic income, that we need to do everything we can to avoid that we get on that path and think about how do we make sure that AI is labor augmenting, not labor displacing.
And are you able to determine what the impact on other economic indicators, whether it's inflation or interest rates or whatever, are happening already, whether that's as a result of the massive capital expenditures that's taking place in that sector or anything else? What are the economic impacts that are being felt now?
Yeah, I think that we look sort of at two aspects right now. And so one, as forecasters, and we're trying to dissect what's going on in the global, the American, the Canadian economy, is that we've really got a two-paced economy, that we've got what's going on in the AI world. So basically, almost all the business investment that's happening in the US economy right now is in that tech, data center, energy sectors. So that's really holding up not just business investment, but quite frankly, a good chunk of US economic activity right now is being held up by this subset of activity as well. And then you layer in the wealth channel of what's been going on in equity markets, and that also supports consumption, that consumers, individuals feel wealthy and they're more likely to consume. And so, there are multiple channels right now where that whole AI play is really kind of masking a broader weakening given other headwinds in the global and American economies right now. So we certainly need to unpack some of those different drivers because of what's going on. But as we look over the horizon, then we need to think about, okay, so if these trends continue, if we continue to see build out, what would happen to inflation and hence interest rates and, investment and consumption activity over the long run? And that's where you start to get in the near term, you can sort of understand theoretically that lots of investment that could really push up inflationary pressures, particularly if you think about the supply chain bottlenecks for stuff that's required for energy and chips and so forth. But as you start to look over the medium term, the theory can say, okay, that yes, over the medium term, greater productive capacity or more supply in the economy could be deflationary, but at the same time, greater demand, if we're all wealthier, higher productivity, higher output, that demand could offset the supply side dynamic. And at the same time, if in that positive scenario that there's this continued demand for capital, greater returns on capital from this AI story, that can also push up the neutral interest rate so that the whole rate spectrum goes higher. And I would say very early days, and you can read studies, especially over the medium term, that'll say it'll be mildly inflationary. Others will say mildly deflationary. You have to unpack what their assumptions are, and then you have to have a bit of a healthy dose of skepticism that nobody really knows right now. So it is one of those things we need to monitor.
I guess I'll just add a lot of the studies out there, to Rebekah's point, imagine a chart, you see inflation rising in the short to medium term, and then it kind of starts to taper off to varying degrees depending on the study. So as those productivity gains feed through, that's when you get that disinflationary effects start to come through as well. But all these studies are also based off of the assumption that we don't get a significant deterioration in the labor market. Because if tomorrow unemployment as a result of automation was to rise to, say, double digits, that is clearly going to be a net negative and arguably prove deflationary over the long haul. It is operating under the assumption, and to Rebekah's point, why we have to be kind of skeptical of all the studies we look at, that the labor market picture doesn't deteriorate significantly.
Can you give us some numbers around the impact on productivity and growth?
Sure. I mean, there's wide-ranging estimates, some of them very optimistic. The most optimistic one is calling for productivity growth of approximately 1.7 percentage points per annum over the next 10 years. And that's outstanding if that happens. And then you've got more pessimistic scenarios, which are calling for productivity gains to the tune of only about 1/10 of a percentage point per annum over the next decade. So kind of on the opposite sides of the spectrum. And I think like most things in life, the truth is somewhere in the middle. The average across the studies we looked at is about 0.5 percentage point uplift to total factor productivity growth, which is something. It's not nothing, because if you look at the 10 years leading up to the pandemic, the US had an average productivity growth of 0.8 percentage points. So a 0.5 percentage point uplift is about a 60% uplift there. And I think they'll take that. You know, Rebekah spoke about Canada's struggles with productivity growth. I'm sure Prime Minister Carney would be more than happy to take a 0.5 percentage point uplift to TFP as well. So, you know, we'll see what happens, but I reckon the truth is probably somewhere in the middle. And then in terms of growth, I like the way the IMF phrases it. So they have a low TFP scenario and a high TFP scenario. And under their low scenario, they suggest GDP growth will be about 1 to 1.5 percentage points higher than the baseline. And in a high productivity scenario, we get growth perhaps as strong as 5 percentage points stronger relative to baseline. So wide range of estimates, and it speaks to, I think, the uncertainty of how AI is going to impact the global economy.
Okay. And I guess related to that uncertainty, I mean, there's so many things we just don't know yet as this new technology evolves. One thing I think a lot of people think about, or at least people who, like me, are old enough to remember the dot-com boom of the late 90s and the subsequent bust that happened after that in the early 2000s. I think a lot of people wonder whether we are in a similar type of bubble where there's this massive enthusiasm, lots of money being poured in. What do you think? Are there legitimate comparisons to be made between what happened with the bubble in the early 2000s and what's going on now? We'll start with you, Walid.
I mean, if I had a nickel for every time I get this question, I think it's an important question. I do think that many of the similarities that we draw between the dot-com era and the present are actually warranted. You know, you think about some of the similarities. We have elevated valuations now. We had them before. We have narrow market leadership. Back then, it was the entire infotech space, and today we have what's known as a Magnificent Seven cohort. We had promises of significant productivity gains, and that led to a CapEx cycle where companies back then started to deploy funds or investment into software, into personal computing. And today we're seeing a similar trend play out with data centers, advanced semiconductor chips. Energy is another sort of underappreciated factor. So there are similarities. But I think it's also important to identify a few differences as well. And the most important distinction, I think, has to do with the types of companies that we have today versus the types of companies that we had before. In the dot-com era, many of those companies' stock prices were fueled by hype, not fundamentals. Exuberance got ahead of fundamentals like earnings, and many of those companies failed to generate any material amounts of cash flow or earnings. You contrast that with the companies we see today, the AI leaders. These are high-quality companies with diversified business models. They have strong free cash flow generation. They have strong returns on invested capital. And much of the CapEx that they have embarked on is actually not being financed through debt issuance or IPOs that dilute the share value. No, it's actually being financed internally through cash that they have, massive amounts of cash that they're holding. So I think that's a very important distinction to make. I'm not saying there's no risks out there. I think the biggest risk that comes to mind is to do with valuations, and they are undeniably rich. If we look at the price to earnings multiple of the Mag 7 cohort on a 12-month forward basis, at its peak, it was around 35 times forward earnings. That's very high relative to what we saw in the pre-pandemic period, but it's not as high as some of the heights that we saw in the dot-com era. And of course, what was at the center of the dot-com era? It was the infotech space. It had at its peak a price to earnings multiple of around 60 times forward earnings, so nearly double. So while valuations are high today, absolutely, they're not to the levels of exuberance that we saw 25 years ago. And I guess the last thing I'll say about this is that I would give a much higher likelihood of companies in this day and age to ultimately grow into those valuations and being able to justify those valuations. And what I mean by that is, if these companies continue to deliver on earnings, if AI holds a promise of reducing costs and expanding margins, then I think, although there's probably limited room for multiple expansion, given that they're already stretched, earnings can continue to drive equity market performance going forward and ultimately allow us to grow into these valuations over time.
Okay. Yeah, I remember that term, irrational exuberance, that was tossed around quite a bit in those days. How about you, Rebekah? Bubble or no bubble?
Well, what I would say is, as an economist, the internet didn't go away with the dot-com bust. And I think that that's something good to remember is over the long term, AI isn't going away. The AI story is going to play out over the next years and, decades. And so I think one has to think it is going to be a bumpy ride. And we celebrate the Nobel Prize economist a couple of weeks ago, Canadian, talked about creative destruction. And he wrote that paper 30 years ago. It's not new that the kind of on a path of revolution or significant change or disruptive change in economies, there will be winners and losers along that path. And so I think that with that in mind, I leave it to folks like Walid to help identify what the winners and losers are. But we know that it is going to likely be a volatile path as we go there. I would point out a couple of differences in the context to today versus before. And a really big one would be the geopolitical context right now. So in the dot-com era, we were in a globalization, trade liberalization. We really didn't have to worry about things like export controls. And now you layer on technologies that are extremely resource dependent, energy dependent, critical minerals, semiconductor chips that are held within parts of the world that are increasingly restricting access to those technologies. So there's this geopolitical overlay that could very well disrupt the best laid plans in terms of the technologies. And on the flip side, I would say also productivity has never been worse, has never been lower than it has ever been. And in the dot-com era, we were still enjoying relatively decent productivity growth in the economies like the US. But right now, we can't afford to not have this work out well for the global economy, for the American economy, because we're kind of running out of drivers and our labor forces are shrinking and less demand for capital because for all these reasons. And so I think we need to lean on all of the policy levers and business investment opportunities in a very kind of structured, disciplined way to really engineer that stronger growth. And that's what you see in the likes of the policies that were being enacted here in Canada. I would also say, keep in mind, AI in itself is not the end goal, that at least for economists, productivity and welfare are the end goals. And so maybe that helps enforce some discipline. And so don't necessarily just chase the shiny bauble, but look for the technologies and the opportunities that it actually is going to lead to more output for the amount of capital and labor that we use as a society.
Right.
I think another important aspect that we aren't talking about enough is the role that AI could play in welfare. And so, as economists, we measure productivity mostly in the business sector because we only have data for that. But in the Canadian economy, for example, 1 in 5, roughly, labor force works in the public sector. Think healthcare, education, not to mention a longer list of public services. So there's huge potential that citizens, that Canadians can feel welfare improvements from greater innovation in healthcare or greater innovation in learning and education, in service delivery that we may not actually see in the metrics that we measure as economists, but that could have real welfare impacts on citizens. And not to mention the role that governments can play in boosting innovation, the public R&D role and the innovation diffusion and the frameworks around that. And even as procurers of early stage innovations, early stage AI uses to help build that scale and those test cases. So I think that we need to think also about the other broader domains that AI can deliver better value or better outcomes for citizens.
Okay. What is the takeaway here? What are the top 2 or 3 things? It's a long report. It's got recommendations around policy and other things at the end of the report. What should people be taking away from this conversation and from the report that you put together?
If we think about the key takeaways, one is that there's just huge uncertainty where this is all going in economic terms. I think 2, we need it to go somewhere positively because productivity, economic output has been weakening. So we really do need some positive news story there. 3, though, we need to be prepared with the policy frameworks for any number of scenarios. And I think for me, one playbook for policymakers that they should be thinking about is where the gains could be transformational. They really need to look at how can we accelerate those gains, accelerate the diffusion, but also acknowledge where that path is transitional or potentially disruptive. They need to think about how to cushion and help that adjustment. So workers help them reattach, reskill, rejoin the labor force as quickly as possible. And third, where there are tensions or potential uncertainties that we need to think about how do we mitigate the risks without actually stalling or impeding that innovation that we need so badly.
Similar question to you, Walid. Amid all that uncertainty that Rebekah was just talking about, from an investor perspective, how do you wrap your head around that?
I think it's very important throughout this entire conversation. We've talked about how uncertain this is. How is it going to play out exactly and what the economic investment impact is going to be? And I think when you have elevated uncertainty, you need to go back to basics. And that means going back to tried and true investing principles, maintaining a high quality bias and being diversified. And I mean, not just being diversified across regions, but also being diversified across sectors. Right now, some of the early beneficiaries are in the infotech space or the space that's directly tied to artificial intelligence. Over time, if this thing pans out, perhaps other sectors, companies in other sectors are going to be able to capitalize on AI by reducing cost and implement it appropriately to expand margins and corporate profits. So having diversified exposure to get a benefit from those second round winners from AI is extremely important. But because of that uncertainty, diversification is really the core tenet that can help to mitigate volatility in portfolios. I doubt that this is going to move up in a straight line. I think there could be some choppiness along the way. And the best defensive player that we have to combat that is fixed income. Bonds, obviously are at this time, sovereign debt is providing very healthy yields, both on a nominal and inflation adjusted basis. And I think that if having a bit of fixed income exposure, maybe even looking into alternative assets, that can really help to lower volatility in investment portfolios and help investors stay invested over the long haul. And the last point I'll make, and this kind of goes back to something Rebekah said, when we were coming out of the dot-com era, there were many, many companies that went under. And kind of deservedly so, because they didn't really produce any earnings. But then there were a lot of companies who, although weren't spared from the sell-off, actually came out of it stronger. So think about your Microsofts and your Ciscos and Amazons, for instance, which over the last 25 years have done exceptionally well. Could we have a similar sort of scenario play out if, let's say, there is volatility and we do get a correction? who's going to be the winners going forward? Because just like the internet continued on and the tech bubble bursting didn't lead to the end of the internet or personal computing, it actually accelerated it. I think a similar trend with AI where it's here to stay, and positioning by being invested in the highest quality companies is something that I think can allow investors to benefit over the long haul as well.
Walid, Rebekah, thank you so much for joining us. Really appreciate it. Great conversation.
Thanks for having us.
Thank you.
I've been speaking with Rebekah Young, Vice President and Head of Inclusion and Resilience Economics at Scotiabank, as well as Walid Khalid, the Director of Investment Strategy at Scotia Wealth Management. The Perspectives podcast is made by me, Stephen Maurice, as well as Armina Lagaya and our producer, Andrew Norton. For a transcript of this episode, as well as other stories, insights, analysis, and thought leadership, visit our website, scotiabank.com/perspectives. We'll see you next time.